Hello again. Thanks for stopping by. I'm Michael Carr, Simplifymyretirement.life, license 2630482. Please see my disclaimer video for more details. This is going to be a little bit of a long one. Today we're going to talk about some research I've done regarding your local advisors, regarding why I'm no longer a fee advisor. I'm calling this the rise and fall of your Main Street advisor. I have a lot of notes. I'm going to be looking down a lot. As I said, talk about history, put some events together for you. Want you to see the evidence of the change that's been going on since 1999. The investment world has drastically changed, and the fee advisor looks to be on their way out. I'm not here to give recommendations or yell at advisors. I used to be one. Just so you know, times have moved on. That's why I'm not a fee advisor anymore. Let's talk in more details. If you're a client of one of the Main Street advisors, it doesn't matter which, and not all the financial advisors I'm going to talk about are on Main Street, but I'm not going to pick on any one company. As I will say over and over again, it's not an advisor problem, it's a math problem with the system. My goal is to get you to ask yourself some questions. Should I still be with a fee advisor? Am I still involved in an old-fashioned investing system? Am I paying high outdated fees for outdated technology? I know it's hard to pay attention to the investment world when you're busy at work, trying to save money to invest. I know that sometimes when you do see news, it's hard to figure out how it affects you and your family. So I'm going to put together headlines that you will remember seeing, events you'll know. I'm going to put them in a narrative so you can understand for yourself the incredible assault Main Street advisors have been under for the last 27 years and why their business model just doesn't work, in my opinion. And frankly, in my opinion, it's not right for anybody. But anybody's a strong word. I imagine an exception would be somebody young and wealthy with lots of disposable income. Maybe the outcome of their work life is already reasonably safe. But since I specialize in people nearing retirement or already in retirement, I feel wholeheartedly it's a bad idea to pay unnecessary fees. It could prove very detrimental to your retirement. The news is clients have been leaving fee advisors in large numbers. The headlines are a little hard to find. I'm going to highlight some research, tell you the research company name if you want to look them up. I'm citing trends. The numbers are easy to verify on Google. These statistics and the history allow you to see how Main Street advisor business has been hammered again and again, and how it has lost or is quickly losing its relevance in a free information and often free to invest society. When did the downfall begin? Did it begin in 1999? The dot-com bubble? Maybe, but that's also when online trading began. So important. You tell me in a minute if you agree that was the ringing of the bells, the beginning of the funeral procession for the Main Street advisor. I'd like to know your opinion. All right, now we're going to go through some history, regulations, products that changed the investing world drastically in favor of you, the individual investors. That's what this is all about. My practice, mostly about retirement, but for younger people than that, I am telling you, you don't need to go down that route either. I'll do a video with some actual examples. I'll be able to put together 4 or 5 examples that show you the time and the effect of fees and expenses. I'll show you the difference down different paths, and you decide for yourself how that works. But if you're still in the old pay to play and hope model, I'd like you to ask yourself why again. Here are some stats to start us out. Currently, according to InspireX Pulse survey published September 10, 24, less than 18% of people under the age of 50, not young people, 30 or 25, less than 1 out of 5 people under the age of 50 are still using the old-fashioned pay-to-play model. The Wealth Report of June 5th, 2025 discusses data from thousands of next-generation high-net-worth individuals that shows 81% of children inheriting money intend to replace their parents' wealth management firms, largely due to poor offerings and lack of alignment with their digital-first lives. Everything's digital for them first. Secondary is going to somebody and paying fees if they can't find another way. It makes sense since digital information, advice, and investing is so much cheaper than in-person investing using third-party advisors and paying their fees. Maybe not so much cheaper, but cheaper factually. So 81%, that's not the beginning of a trend, is it? Do you think 81% represents somewhere in the middle of a trend? Or would you feel 81% represents a fully accepted trend that has once again changed paradigms? That's only 1 out of 5 children that are inheriting money and staying with their parents' advisor. Yay. That statistics makes it clear they're favoring low-fee trends. They're understanding modern finance, how low fees and leverage make a difference. Maybe the younger kids need to teach their parents and get that last 18% of people out of managed money, because it's very dangerous, in my opinion. 30 years from now, who knows how long people could be living? We don't know the future. It could cost you a comfortable retirement to pay fees. You are theoretically open to losing 70% or more of your money, as happened in the NASDAQ from 2000 to 2002, if you're in the pay-to-play model. So replacing financial advisors, not the beginning of a trend, more likely the culmination of a trend. As I said, they've been hammered again and again. Just a little disclaimer in here, I'm not recommending anything. I'm not saying financial advisors are bad people. If you missed it in the first video, I was a registered investment advisor. Lots of licenses. People paid me fees to do financial plans and advise them. I know now I can do better for people without inserting any of my own costs. That's why I'm not there anymore in that system. So here's just a basic advisory story if you want to know what it's like from the inside. When you're young, you're working for a major company like I was. You assume that your company has a good product for every situation, pretty much, every person. Your plans should be in the top of the industry because you're a prominent name. Mine was world known. But I learned the truth the hard way. I didn't have any reason to look around at other companies because everything was going so great. Blue skies forever. House, fiance, my big company was opening an office for me right outside the movie colony in Palm Springs. Life would have been sweet. Except God has a funny sense of humor. Car accident, 3.5 years of disability, everything gone. When I came back from disability, I found myself working as a private insurance adjuster against insurance companies. So here comes some more knowledge. There I learned how with your house, your insurance, your health insurance, everything is open to interpretations. There's just limits. That's all. Your homeowner's policy clearly states, if you read it, that you are required to prove what you're owed if you have a claim at your home. So from the inside, I learned all these things that insurance companies don't seem to care what you're owed. But when I got back to this side of the business, I was very happy. Armed with all this new knowledge, I realized that on this side, everything I do is contractual. The guarantees are really guarantees. The amounts stated are real and paid to you with no interpretation or adjusters. It's on the contractual side of the insurance company equation that I live now. On this side of the insurance equation, you get what you pay for. A life insurance policy in almost every state has to pay in 30 days. No discussion, no fees. Income annuities continue to pay people from large pools so that after or if your account goes to zero, you still get paid from credits that were going to someone that passed away early. So the people that live longer get money that was going to go to people that passed early. This has been going on since the 1640s. So all guaranteed, like I said, it's not too good to be true after 400 years, right? It's important having someone knowledgeable on your side. I understand this. They live in the finance industry. They're available to answer your questions. That can be invaluable. But here's what I think. I think paying them every year for the rest of your life, whether you make money or go broke, is a poor decision. Based on the amount of money they can receive and based on the simple mathematics. Their participation is a drag on your retirement that many people can't afford. What's my proof? The Morningstar Center for Retirement and Policy Studies issued their finding that 45% of Americans are likely to run out of money before they die. Single women face the highest risk at 55% chance they will run out of money before they die, and that's just wrong. There are ways to protect against that. So now we're going to go through some of the history, discover some more of the story, compare and contrast a little bit as I have already. The Main Street advisor against the independent advisor. One history and statistics show is declining. The other, like myself, I think in 10 years there'll be 10 times as many independents, such as myself. All right, so discover some more of the story. Where did the Main Street advisor come from? Why are they under such attacks? If you don't believe they are under attack because they're building new offices, may I suggest you could ask yourself if buildings are cheaper than billboards and national campaigns on television. That may help you with that question. All right, so obviously, investing began in New York City before the 60s. Wealthy people, institutions, they had access to the markets. When companies started opening advisories in the 1960s, they employed fee advisors, many of them independent, kind of representing their own, like an Ace Hardware kind of thing. And they began in Main Street, in small towns. And then help came their way. In 1975, something big happened. The Securities and Exchange Commission, the SEC, abolished fixed commission rates. Now, if you could do it cheaper, you could charge less. And boom, financial advisors started opening in neighborhoods because it was clearly more expensive to deal with them than sending checks or paying who knows what fees in the 60s and 70s to New York. So they brought investing to Main Street. They started out good. They got help in 75, and then in the 80s, they got a lot of help. The 401 was created. Pensions were dying. The 401k was intended to put financial responsibility for your retirement in your hands. Well, if you didn't have a 401k or a pension, many people chose to fund their retirement using Main Street advisors. They were just a walk away. Not just them necessarily, but firms like them, some larger, some still in New York. Also in the 1980s, the mutual fund explosion happened because what's in all of our 401ks, mine, yours, mutual funds, bunches of them. And it's the same if you have a relationship with a fee advisor now. In your approaching retirement or in retirement, that's what you've got. You've got mutual funds. I see them on people's statements every week. I had mutual funds in mine. So now we mentioned this. 1999, the dot-com explosion came with something else. That's when online trading began and fees dropped from whatever they were in New York, $15, $20. And now You can do it yourself online for a few bucks. Not just New York, your Main Street advisors too. It came down to a few dollars. So prices coming down, spreading equality, increasing access. Not many people could afford to pay a $20 fee, let's say, if they're only investing $20 a month. So they'd have to wait, and then they miss out maybe on ups and downs that could have benefited them, those types of things. Then in 2010, more downhill pressure. Robo-advisors arrived on the scene. One I saw mentioned was Betterment. I don't think I really remember that company, but robo-advisors did better than expected. And now the first big hammer comes down on Main Street advisors. 2015, Robinhood and other no-fee, low-fee trading platforms attracting younger investors before they even have a chance to learn about Main Street advisors. You've got 20 bucks, fine, start here. But also, for free, you can read an almost infinite amount of investor material, no matter what interests you: compounding, dollar cost averaging. Whatever you need to start, we'll help you. So they brought investing right down to the youngest people, right? Robinhood's still doing well, billions of billions in assets. They have actually stepped back a little bit, and they now have a human-run advisory service. I assume quite affordable. It already has over $1 billion in it. But here's a comment on the fact that AI is not very useful yet, and so it's not really terribly valuable yet. AI has an investor aide you can talk to in full sentences for $5 a month. Now, critics will say a chatbot isn't a human being. But remember what I said about robo-advisors? Let's look at the hard data. Multiple industry studies tracking investment performance have proven that automated robo-advisory algorithms achieve virtually identical net returns compared to traditional human advisors. They're trading in the exact markets, just without the human overhead. So look at the math. If you have $1 million, a traditional 2% advisory fee strips $20,000 a year out of your pocket. That AI tool costs $60 a year. When independent research shows that the actual investment results are practically the same, you have to ask yourself, what exactly am I buying for that extra $19,940 a year? That fee is a pure drag on your retirement safety. Quite a difference. So that's what's going on. All right? And I'm not done yet. There's another hammer, each one bigger than the last. The .com trading online that hurt your advisor, the robo-advisors, Robinhood, you think that was horrible? Nope. October 1st, 2019, they call it the race to zero. Everybody watching this remembers that. Charles Schwab stood up one morning and said, no more fees for trading. And every investor went, oh boy. And on that same day, the fee advisors' stocks, they went down. Schwab down 10%, TD Ameritrade down 26%, E-Trade down 16%. So the whole investor world is saying, we've been waiting for this. And somebody seems to have immediately realized this is serious pressure on the fee advisors, and the stock prices suffered. And within 48 hours, Fidelity and other companies had to join in. And because a lot of these companies' stocks dropped, the companies were open to mergers, and they did. They merged, and everything changed. Now, at this point, I would imagine fee advisors sitting in their offices hoped everything was done. And then something else damaging had to happen. In December of the same year, 2019, the birth of fractional shares. Doesn't seem like much to you? Listen to how the internet frames it. You no longer had to save up money to buy a share, maybe one share of an expensive company. No more. 1 share, 5 shares, 100 shares. You don't have to worry about that anymore. Now you can say, hey, I've got $5, 20, 50, 200, and I want 27.75 shares. And that changed everything. My research shows that fractional shares entirely hyper-democratized investing. The same for everybody, no matter what, who you were, where you were. All you had to have was the internet, and everything was the same for everybody. Beautiful thing, right? Not so good for Main Street advisors. Why would you go in and ask questions of your Main Street advisor? Why would you have a savings account that you put money into every 2 or 3 months to buy whole shares? Now you can dollar cost average for $5 a month or $20 a month or whatever you want. You can go online and have all your questions virtually, I think, every question you could probably come up with answered in databases by robo-advisors. All right? Everything is starting to democratize. Democratize in the investment world meaning easier, cheaper, more, better information for the average investor, especially the beginning investor, especially the investors that are trying to prepare for retirement after 40 years of working with their head down, not watching financial news, not understanding. Now it's simpler. Now the information's easier to get at. Many people can just sit down for a week or 2 or 3, learn everything they need to know, and make great investment decisions or planning for their retirement. As I keep saying, investment decisions aren't the best because there's a difference. Investment is on the fee side. Insurance products aren't usually investments, they're insurance. That's why I use words like guaranteed, leverage, etc. So, a lot of bad news. Are we done? Nope. Just when you think it couldn't be better, ETFs hit stride, electronically traded funds. They've been around since the 90s, but in the end, they are being called the final extinction event for mutual funds and the people that recommend them most, I would say. Let me see. They've been around since the 90s, but in 2023, ETFs passed mutual funds in volume. Without getting into details, the biggest reason is cost. Mutual funds have these costs and those costs. You've got to do research to figure out some of the fees. But now ETFs, in my research, I've seen charge as little as 0.03%. So now we're down to 1 or 2% on the advisor system versus 0.03%, whatever multiple that is. But here's the thing. ETFs didn't just change the game, they rewrote the investing world. They completely gutted the traditional mutual fund model, stripped away the main reason for financial advisors. Why? Why would I pay a financial advisor to get into a fund with all kinds of fees when if I do my own research and find a similar ETF, I can get into it for less than 1%, maybe even as low as 0.03%? I know this is just a conceptual discussion. Still, why? Why are you still in that system? Why would you still be paying 2% or even 1.5% when you could be paying less? I'm not saying that these ETFs are appropriate for you. I don't know. But if mutual funds are appropriate for you, I can tell you there are ETFs out there that represent almost every mutual fund there is. I haven't done the research, pretty confident in that statement. So lastly, here are some final numbers from Google to let you know the ship has sailed. From what appears to be fiscal October 24 to October of 25, $608 billion right out of mutual funds. In the exact 12-month period, $1.49 trillion. Many times what left mutual funds poured directly into ETFs. So not just mutual funds owners, many people in the industry, many investors realizing, hey, this is an opportunity in their instance. All right? In the first quarter of 2026 alone, ETFs gathered another $135 billion in fresh capital. Now, I want to point out that if in 2019 Fidelity and those big guys realized that this model was dead and you're still using it today, I want you to realize it's likely going to cost you quality of life in your retirement. My dad started retirement around 65. He's 92 now. In 3 years, he'll hit the 30-year mark. Many people that are 65 now, like me, are going to clear 92 no problem. Do you have enough money for a 30-year retirement? Can you afford to pay somebody a couple percent a year? What could 2% a year times 30 years cost you in comfort during your retirement? Do you think your financial advisor can maintain their value through all that, through all the onslaught, through all the new opportunities I've described that are now open to you, including independent advisors like myself, representing insurance products with guarantees, safety, and leverage? Do you think they can maintain their value against that onslaught? They are all about risk. There are 10% variances in the stock market within almost every single calendar year, from high to low. Google Gemini says on average there's an 18 to 20% correction every 4 to 6 years. I'm simply saying, why would you take that risk? And when you see the short video on leverage, you'll see exactly how I do it. But this is why I tell people on the 2 radio stations 4 times a month, the current fee advisor model is dead. If you're worried about running out of money, you should be worried about running out of money sooner if you're paying an advisor. And that's the number one fear of people over 50 years old. It has surpassed public speaking. The number one fear now is people looking at themselves and saying, wow, I look healthy. My parents weren't like this at this age. Do I have enough money to get through a long retirement? Give me a call. Let's find out together. I look forward to more visits with you. I hope this was informative. Bye.